SpaceX is publicly traded, and its market capitalization has crossed $1.4 trillion. Yet its latest quarterly report shows a negative operating margin and a negative net margin. How can a company with under $8 billion in quarterly revenue command a forward price-to-earnings ratio above 63? Some call it the dawn of a multiplanetary civilization, others see a bubble inflated by hype. In this analysis, we ignore the narrative and focus on the numbers. Using the latest SEC filings and industry tracking estimates, we dissect the three main businesses: launch services, Starlink, and Starship. We examine revenue, costs, cash flow, and valuation. By the end, you'll know exactly what the market is pricing in and which milestones could break the story. Start with the contradiction. SpaceX's market cap is $1.43 trillion. Its forward P/E is 63 times, far higher than most tech giants. But the latest quarter, ending June 30, 2026, shows revenue of $7.81 billion, up 92% year-over-year, yet operating margin is negative 1.8% and net margin is negative 6.9%. That means the company loses money on every dollar of sales. How can the market justify such a premium? The answer lies not in current profits but in future expectations. The market is betting that Starlink will transform into a cash machine and that Starship will slash launch costs. But these are hopes, not earnings. Let's break down each business to see if the numbers support the story. SpaceX operates three distinct cash flow machines. The first is launch services, launching satellites for Starlink, NASA, the Department of Defense, and commercial clients. This is the most mature, cash-generative business. The second is Starlink, the satellite internet service. It's the growth engine, but it requires massive capital expenditure. The third is Starship, the fully reusable heavy-lift rocket. It currently generates almost no revenue, but it's a high-upside option. Each has a different risk profile and valuation multiple. The market blends them into one stock price, but they deserve separate analysis. Let's examine each in turn, starting with the cash cow. Launch services are the most reliable cash generator. The Falcon 9 rocket is reused up to 15 times, dramatically lowering costs. Industry estimates suggest the internal cost per launch is around $30 million, while the public price is $60 million or more. That implies a gross margin above 40%. However, the total addressable market is limited. Global launch demand won't multiply tenfold. So this business likely generates annual revenue in the $4 to $5 billion range, which alone can't support a $1 trillion valuation. It's a solid foundation, but not the growth story. The real question is whether Starlink can scale profitability. Starlink's value depends on unit economics. The key metric is the customer payback period, how long it takes for the monthly gross profit to recover the subsidy on the user terminal. The formula is simple: payback period equals the terminal subsidy divided by monthly gross profit per user. With a terminal cost around $600 and an upfront fee of $499, SpaceX subsidizes about $100 per terminal. If the average revenue per user is $110 and the marginal cost is $70 to $80, the gross profit is $30 to $40 per month. That gives a payback of 3 to 4 months. That's healthy. But if terminal costs don't fall or ARPU declines, the payback could stretch beyond a year, forcing constant fundraising. That's the risk. Starlink isn't competing with your local fiber optic service. It targets the 3 billion people without reliable internet, plus aviation, maritime, and remote operations. Traditional networks require digging trenches and building towers, which is impractical in deserts or oceans. Starlink's satellite constellation covers the globe with minimal ground infrastructure. Latency has improved enough for video calls and online gaming, while traditional satellite internet has latency around 600 milliseconds. The economics work. Connecting a remote village with fiber might cost tens of thousands of dollars, while a Starlink terminal costs a few hundred. However, capacity is limited. Urban areas would saturate the satellites. So Starlink becomes a necessity in the gaps, not a replacement for fiber. The most important financial metric for Starlink is free cash flow conversion. Free cash flow is operating cash flow minus capital expenditures. The conversion rate is free cash flow divided by adjusted EBITDA. Adjusted EBITDA is a proxy for operating profit before interest, taxes, depreciation, and amortization. For 2025, industry estimates put Starlink revenue above $10 billion, with adjusted EBITDA around $3 billion. But capital expenditures, satellite manufacturing, launches, ground gateways, might be $2 to $2.5 billion. That leaves free cash flow of $0.5 to $1 billion, a conversion rate of only 20%. That means for every dollar of EBITDA, 75 cents is reinvested. The hope is that as the network matures, capex intensity falls, and conversion rises above 50% by 2028. Until then, Starlink is still a capital-intensive business. Starlink's user growth has been explosive, but average revenue per user has stagnated. According to industry tracking, users grew from about 1 million at the end of 2022 to an estimated 6.5 million in 2026. That's a steep curve. However, ARPU has hovered around $110 since 2024 and may be declining slightly. The reason is that new users come from lower-income regions like Africa, Southeast Asia, and Latin America, who buy cheaper plans or pay per use. So if you extrapolate total revenue from user growth alone, you'll overestimate. A better approach is to track the gap between user growth and revenue growth. If users grow faster than revenue, unit economics are deteriorating. To maintain ARPU, Starlink must expand into high-value markets like aviation and maritime. Starship is the wild card. It currently generates zero commercial revenue, relying on NASA's Artemis contract for survival. The success rate of test flights is around 60%, with only 5 orbital insertions as of mid-2026. But its promise is to cut the cost to orbit from thousands of dollars per kilogram to below $200. That would rewrite the economics of space. In financial terms, Starship is a deep out-of-the-money call option with a strike around 2028. The key metrics to watch are flight success rate, number of orbital insertions, NASA contract milestones, and most importantly, full reusability. If Starship achieves full reuse, launch costs could drop to $2 million per flight. If not, it becomes a money pit. Investors should treat Starship as a separate bet, not part of the current valuation. Let's put rough numbers on each business. Launch services, with a stable cash flow, might merit a multiple of 15 times EBITDA, suggesting a value of $30 to $40 billion. Starlink, based on 6.5 million users and a per-user value of $200 to $250, is worth $130 to $160 billion. That's a high multiple compared to traditional telecoms, reflecting growth expectations. Starship is the most speculative, with valuations ranging from $30 to $100 billion, essentially an option premium. Adding these up, you get a range of $165 to $300 billion. That's far below the current $1.43 trillion. The gap implies the market is assigning an extremely high value to Starlink users, perhaps over $3,000 each, or a high probability of Starship success. That's aggressive. Here are the key financial metrics from the latest quarter. Revenue is $7.81 billion, up 92% year-over-year. But operating margin is negative 1.83%, and net margin is negative 6.92%. The company has $23.68 billion in cash and $30.60 billion in debt. That's a net debt position. The forward P/E is 63.17, and the price-to-sales ratio is 73.94. These are extreme valuations for a company that isn't yet profitable. The market is betting on future growth. But with negative margins, any hiccup could cause a sharp re-rating. Watch these numbers closely. The current valuation implies that Starlink will become an incredibly profitable business, similar to Amazon Web Services in its early days. It also implies a high probability that Starship achieves full reusability by 2028. If either fails, the stock could face significant downside. The market is not pricing in the risk of ARPU decline or prolonged capital intensity. It's also ignoring the possibility that launch costs don't fall as fast as expected. For investors, it's crucial to separate the three businesses and assign different risk premiums. The current price is a bet on flawless execution. Starlink is growing exponentially, and the moat is real. But they're losing money on every user. Starship will change the economics of space. It's still a prototype with a 60% success rate. The market is pricing in future cash flows. Those cash flows are years away and uncertain. Instead of watching Elon Musk's tweets, focus on these data milestones. First, Starlink's free cash flow conversion rate. It needs to stabilize above 40% to justify the valuation. Second, ARPU trends. If ARPU continues to decline, the revenue model weakens. Third, Starship's progress. 2 successful orbital insertions and full recovery would be a major validation. Fourth, launch cadence. How many Starship launches per year? Fifth, Starlink's enterprise revenue. Growth in aviation and maritime will support ARPU. These are the metrics that will move the stock. If you're an investor, set your own thresholds. SpaceX is not a simple buy and hold faith stock. It's a complex portfolio of 3 assets with different risk profiles. Launch services provide a stable but limited cash flow. Starlink is the core growth engine, but it needs to prove it can generate free cash flow. Starship is a high-risk, high-reward option that could either transform the industry or become a money pit. The current valuation already reflects optimistic expectations. If Starship doesn't hit its milestones by 2028, or if Starlink's ARPU keeps falling, the stock could face significant downside. For disciplined investors, wait for the data. If you prefer short-term trading, watch the key metrics. Thanks for watching. Let us know what you'd like us to dissect next. Remember, risk management first. Markets reward discipline, not certainty. If this analysis helped, like the video and subscribe to DeepQuant. Tell us in the comments which market idea we should test next. Evidence beats noise. Control risk before chasing returns.